Hello again, Mark Sturdy here with a summary of our work again this week, looking at the charts, short, medium and long term of major world markets, world liquid markets. And with that in mind, it is worth observing there's enormous volatility in some markets, not all, but some. And the sort of volatility that is a result of a breakdown of consensus as to whether they go up or down. And the chartist should respond to this, as we have done, and I will do when I talk, by first of all pulling further away from the shorter term charts to the longer term charts to show larger movements, wilder movements in a wider context. That's the first thing to do. And the second is to pay close attention to closes rather than intraday trading ranges. So we will be doing that when I go through. Let's look at the summary, and you'll see that very little's changed from last week. We are still bears of the yen against the dollar. The dollar has been on a rallying run for since December, and the yen is weakening, and the chart there is excitingly clear. The long-term chart is the continuation triangle at the point of breakout from a prior high, which is exciting, and it has completed, driving the market up, we think, eventually to 175 plus minimum. And you will see that right at the current levels, we are pushing above a prior high, 158.87, which once above, we failed there once, but once above it, if we can establish ourselves, that should act as good support on any pullbacks. And possibly, we could regard it as, in addition to the triangle, being the completion of a double bottom, which would drive the market up, perhaps even a little higher as the minimum move than the distance suggested by the triangle alone. You'll see that we are sitting right on this 158.08 level. If we can get through it, all well and good. But currencies in general have been rather put to one side by the dramas in stocks and bonds, and I don't have a lot to say except to observe else about currencies, except to observe that the sterling euro, which we thought was pregnant with possibilities insofar as last week the market was teetering on completing a head and shoulders reversal, I said wait for a break of the neckline. It never came, and that is now somewhat confused and therefore stand back. But let's move on to stocks. The least affected market of all is the S&P 500, the Americans. There's the bull run. It's scarcely been dented. This is what I mean by looking at very long-term charts to put things in context. There has been a sell-off, but it has yet to break the first point of reference, which is 64.56. Until that breaks, the market stays solid. If it does break, however, then there would be a medium-term breakdown, no question about it. Very short-term, we can see there are lots of reasons why the bulls will be worried, insofar as there is now good resistance above the market from these prior lows. So if the market tries to rally, it will have problems at 66.39, which is both there and there. Conceivably, you could regard this as a completed top. It's a little confused, a little unclear. So I don't put great weight on that, and I certainly put greater weight, as I suggested earlier, on the longer-term chart and the support of 64.56, and watch and wait for important closes rather than price action intraday. This is the Eurostoxx is, however, a different case from America, and it's been much more severely hurt. You can see on the long-term chart, there has been a big attack on this support, 55.24 from the 1990s. That's an important level, 55.24, rather the year 2000. That's important, and you can see it's broken. The market's broken both short and long-term supports. If the market closes this week below that level, that is very poor. No question about it. Looking on in more detail, this is the price action we're looking at here in the June 26th. So this week it closed below 54.95 on the week in the June, the critical week. That's the medium term level, but it's trading around that high volatility. Watch and wait if you can for closes. And here's the price action here today, which is quite dramatic. The FTSE and the Nikkei are obviously they've been sold off. That is not a monthly key reversal. In the context of the long-term charts, it is a sell-off well within the possibility of this is no great breakdown of this, I submit. of this bull run and needs to be watched. Certainly it's broken its near-term level, not desperately convincingly. Were this to close above that, all bets would off. There is a continuation triangle that suggests great bearishness, but nonetheless, this is not as bad as the Euro Stoxx 50, nor is the Nikkei 225. You can see here there has been a pullback to first level of support, 52,500. It has yet, and it is traded down through it last week, so it is under threat. Note this head and shoulders top. I think a break beneath 51,000 would look very poor intra week. So this, I'm contradicting myself somewhat. This Nikkei does look as poor as the Euro Stoxx 50. It's the FTSE that doesn't. This looks as poor as that, so it does suggest further on the downside. Bonds too are highly volatile. The exception has been the US Treasury note in the middle of a trading range, and broken down through a prior low here, which will act as good resistance on any attempt to break up. Wide trading ranges. So stand back from the daily chart. Note that we're in the middle of a trading range, and I don't think get involved in US notes. German Bund, rather like the stock market, is more interesting and I think more exciting for traders. Here we are, we're attacking quite strongly the band from 294 to 299 and these two previous highs. In closing terms, this is what the breakout looks like, and I think this is significant. As I suggested, closing terms in times of high volatility do matter more. And there is the breakdown, the short-term price breakdown beneath 25.90. You'll see massive volatility here. Once again, look at closes. But concentrate, as I suggested before, on the big picture, which suggests to me a problem for the market to get down beneath 22.90 and an open-ended exposure to higher levels than that. The gilt is similar to the German Bund. We have been bearish. We have been frustrated here. The completion of this triangle suggested lower. It didn't want to go lower. It didn't want to go higher. And then price-wise, last week was a brutal piece of price action for this and suggests now that the market will struggle to get above 89.23. This is the yield chart. Not yet the completed triangle that you might want to look for, but certainly we've pushed up above 492, and that's the highest close so far. This is the sort of price action, 93.50 down to 86, a dramatic 7 big figure sell-off. An attempt to rally back above 89.79 here failed dramatically. Expect great volatility. As I say, look again to the closing levels and remember, and the bigger chart, the longer term charts. So these are the big charts to look at rather than the daily ones. Bearish, I think, both for the Bund and the gilt. US notes stand aside. Oil, we know, has been wildly, but more consensual trading, i.e. going up without much confusion. It hasn't yet broken 105 on a closing level, which I think is important. Were it to do so, it suggests to me that it could go a lot higher, but it hasn't done it yet. There is the confused short-term chart. There is a slightly consensual piece of price action there. Low volatility just driving higher. Gold, well, we talked about gold last week and said it was vulnerable, and sure enough, we have had this massive sell-off. It has now broken at the end of close of last week through the first important prior high support, 43.98, where it had bounced before. It's now broken down through that. That is bearish for gold. It will struggle to get back above there, it seems to me, and stand aside from the short-term price action, which is now gaining in volatility and trying to find fair value and struggling. Thanks very much.